Sometimes news about the stock market sounds hard to understand. For example, recently President Donald Trump paused tariffs for 90 days and the news started saying that all the stocks went up. You might hear names like the Dow Jones going up or down. Many people do not know what this means. But the stock market is important. It is a way people can make their money grow bigger over many years. It has helped many normal people save money for the future. Let's look at an example. Imagine a man named Aaron. He started working in 1981. He decided to save $400 from his pay every month. He put this money into a savings plan from his job. This plan put his money in the stock market. Aaron did this every month for 39 years. In total, he saved about $192,000. After 39 years, Aaron looked at his savings plan. How much money did he have? He had over $3 million. Aaron was very surprised. He only saved $192,000. Where did the extra money come from? It came from the stock market. His money grew slowly at first. After 1 year, he had saved $4,800. His savings were worth just a little more. But after 10 years, he had saved $48,000. Now his savings were worth over $100,000. His money started to grow faster and faster. This happened because the stock market usually goes up over long periods. On average, it grew about 10% each year during Aaron's working life. This does not happen in a straight line. Some years the market goes down. But over many years, it has always gone up more than down. This is why the stock market can help turn small savings into a lot of money. Understanding the stock market is useful. Many people have money in the stock market already, maybe in a retirement plan from work. They might not even know it. When you understand how it works, you can use this tool better. This story will explain how the stock market helps money grow. It answers the big question, why does the stock market usually go up over time? 2. What is stock? Imagine 3 friends want to start a coffee shop. Let's call it Best Coffee Company. They need $10,000 to open the shop. One friend, Natalie, puts in $6,000. Another friend, Ethan, puts in $3,000. The last friend, Lauren, puts in $1,000. How do they show who owns how much of the coffee shop? And how do they protect themselves if something bad happens, like a customer getting hurt? Businesses often solve these problems by becoming a special type of company called a corporation. A corporation is like a separate person in the eyes of the law. This helps protect the owner's personal money if the business has problems or owes money. Corporations can get money by selling small pieces of the company. These small pieces are called stocks or sometimes shares. When you buy a stock, you buy a tiny part of that company. You become a part owner. People who own stock are called stockholders or shareholders. Let's go back to Best Coffee Company. Natalie, Ethan, and Lauren decide to make it a corporation. They decide the company will have 10,000 shares in total. Because Natalie gave 60% of the money, she gets 60% of the shares. That's 6,000 shares. Ethan gave 30% of the money, so he gets 3,000 shares. Lauren gave 10%, so she gets 1,000 shares. Now it's clear how much of the company each friend owns. Natalie owns the biggest part, Lauren owns the smallest part. Why would someone want to own stock? Owning stock can be valuable. As a part owner, you have a right to a part of the company's success. If Best Coffee Company does well and makes money, that money is called profit. Let's say the coffee shop makes $5,000 in profit in its first year. The owners might decide to share this profit. When a corporation shares its profits with the owners, it's called paying a dividend. Because Natalie owns 60% of the shares, she gets 60% of the dividend money. That's $3,000. Ethan gets $1,500 and Lauren gets $500. This is one reason why stock has value. It gives you a claim on the company's profits. Sometimes companies don't pay dividends. They might keep the profit inside the business. They can use this money to grow, maybe by opening more coffee shops or buying better coffee machines. Even if they don't pay a dividend, the profit still belongs to the shareholders because they are the owners. This makes the company more valuable over time. So a stock is simply a share of ownership in a corporation, giving you a piece of its future success. 3. What is the stock market? You know that stocks are small pieces of a company, but where do people buy and sell these stocks? They do this in the stock market. Think about a farmer's market. Farmers bring their food and people come to buy it. The stock market is similar, but people buy and sell stocks instead of food. It is a place where buyers and sellers meet. Someone who owns stock can sell it to someone who wants to buy it. There are famous stock markets in the world. One very big and old one is the New York Stock Exchange, often called the NYSE. It started a long time ago on a street called Wall Street in New York City. People used to meet there in person to trade stocks. Another large market is the NASDAQ. NASDAQ is different because it uses computers to connect buyers and sellers. Many technology companies list their stocks on NASDAQ. These markets help people easily trade stocks from many different companies. It can be hard to know if most stock prices are going up or down on any day. Are companies doing well overall or not so well? To help understand this, we use something called a stock market index. An index is like a basket that holds many different stocks together. By looking at the index, we can get a general idea of how the whole market is doing. It is like checking the temperature for the whole city, not just one street. You might have heard names like the Dow Jones or the S&P 500. These are famous stock market indexes. The Dow Jones Industrial Average, or just the Dow, tracks the stock prices of 30 very large American companies. It was one of the first indexes, started a long time ago to help people see the market trend. It shows if these big companies are generally going up or down in price. Another important index is the S&P 500. This index tracks 500 large companies in the United States. Because it includes many more companies than the Dow Jones, many people think the S&P 500 gives a better picture of the total U.S. stock market. It includes companies from different parts of the economy, like technology, health, and stores. When you hear news about the S&P 500 going up, it usually means that most big companies' stocks did well that day. These indexes help everyone quickly understand the market's direction. 4. Why companies sell stock. Think about the Best Coffee Company again. Natalie, Ethan, and Lauren want their business to grow. They believe they can make more money by opening new shops. Let's say they want to build 10 new coffee shops. They estimate this will cost $100,000. Where can they get this money? One way is to borrow money from a bank, but loans must be paid back, usually with extra money called interest. This can be risky if the new shops don't make money quickly. Another way is to sell stock. Selling stock means selling small pieces of the company to other people, called investors. This is a popular way for companies to get money for big plans, like building new stores or hiring more workers. The good thing about selling stock is that the company gets money it doesn't have to pay back like a loan. The first time a company sells its stock to the public is a special event. It is called an initial public offering, or IPO. To do an IPO, companies often get help from special banks called investment banks. For Best Coffee Company, the investment banks might suggest selling 10,000 new shares for $10 each. This would give the company the $100,000 it needs. But there is a downside to selling new stock. Before the IPO, Natalie owned 60% of the company, Ethan owned 30%, and Lauren owned 10%. After selling 10,000 new shares to the public, there are now 20,000 shares in total. Natalie still has her 6,000 shares, but now that's only 30% of the company. Ethan's 3,000 shares become 15%, and Lauren's 1,000 shares become 5%. The public investors own the other 50%. This is called dilution. The original owners now own a smaller piece of the company. Companies like Starbucks also had an IPO. In 1992, Starbucks sold stock to get money to open more stores. It's important to know that the company only gets money when it sells new shares, like during an IPO. Later, when investors buy and sell the stock from each other in the stock market, the company does not get any money. The money goes between the investors. So, why do investors buy stock if the company doesn't get the money after the IPO? Investors buy stock because they hope to make money. There are two main ways. First, the price of the stock might go up. If an investor buys a stock for $10 and sells it later for $15, they make $5. This is called a capital gain. Second, some companies share their profits with stockholders. These payments are called dividends. 5. Why stock prices go up and down. Stock prices often change. They can go up one day and down the next day. Why do stock prices move like this? People who buy stocks are called investors. When investors decide how much a stock is worth, they think about the company. They try to guess how much money or profit the company will make in the future. These future profits are also called earnings. The price of a stock often depends on how much profit investors believe the company can earn later on. Investors also decide how much they are willing to pay today for those future profits. There is a simple way to look at this. It is called the price-to-earnings ratio, or P/E ratio. This number shows how many dollars investors are paying right now for each $1 of the company's profit. A lower P/E number might mean the stock is cheaper compared to its profits. A higher P/E number might mean it is more expensive. What if investors think a company will make a lot more profit next year and the year after that? They are usually willing to pay a higher price for that company's stock today. This means they will often pay a higher P/E ratio for companies that are growing quickly. Growing companies usually have higher stock prices than companies that are not growing much. But stock prices change a little bit almost every single day. Why does this happen, even when the company itself seems the same? There are two main reasons for these daily changes. First, news about a company can change its stock price quickly. Imagine good news comes out. Maybe the company made a very popular new phone. Investors might feel more positive about the company's future profits. They might be willing to pay more for each share of the stock. This makes the P/E ratio go up and the stock price goes up too. Now imagine bad news. Maybe the company lost an important customer. Investors might worry about future profits. They might only be willing to pay a lower price for the stock. This makes the P/E ratio go down and the stock price goes down. Second, prices can change even when there is no big news. This happens because of how investors feel about the future. These feelings are sometimes called market sentiment. If many investors feel hopeful or optimistic, they might buy more stocks. This demand can push prices up a little. If many investors feel worried or pessimistic, they might decide to sell stocks. This selling can push prices down a little. These feelings can change from day to day, causing small price movements. While prices move up and down every day because of news and feelings, something else is more important over many years. Over the long term, a stock's price usually follows the company's actual profits or earnings. If a company successfully makes more and more profit over several years, its stock price will usually go up during those years too. If its profits go down over a long time, its stock price will likely go down as well. So, stock prices move constantly because investors are always guessing about future profits and deciding how much to pay. News and investor feelings cause prices to change day to day. But over the long run, a company's real success in making profits is usually the biggest reason its stock price goes up or down. 6. Why the whole market goes up. In the last chapter, we learned that the price of one company's stock usually follows its profits over many years. When a company makes more money, its stock price often goes up. The same idea helps explain why the whole stock market tends to go up over long periods, like 10 or 20 years. The stock market is made up of many different companies. When we talk about the whole market going up, we often look at something like the S&P 500 index. This index tracks the prices of 500 large companies. Together, the prices of these companies usually follow the total profits of all these businesses. If the total profits of these companies grow over time, the stock market index usually goes up too. But why do company profits usually grow over many years? There are several important reasons. First, there is inflation. Inflation means that the prices of things like food, clothes, and cars slowly increase over time. Because prices go up, companies can often sell their products for more money. This means their sales numbers grow, and often their profits grow too, even if they sell the same amount of things. Second, companies get better at doing things. They find faster or cheaper ways to make products or offer services. This is called productivity. For example, a factory might use new machines to make more goods in the same amount of time. When companies become more productive, they can make more profit. Third, companies create new things. They invent new products or services that people want to buy. Think about things like smartphones or online shopping. These did not exist many years ago. This is called innovation. New products and services create new ways for companies to make money and increase their profits. Fourth, companies sell their products in other countries. A company might start in one country, like the United States, but then it can grow by selling its products to people all around the world. This is called international expansion. Selling to more customers in more places helps companies grow their profits. Fifth, the number of people in the world grows. Every year, there are more people on Earth. More people means more customers who need to buy food, clothes, houses, and many other things. This population growth helps companies sell more and increase their profits over time. Sixth, companies buy other companies. Sometimes a big company buys a smaller company. This is called an acquisition. When a company makes an acquisition, it adds the smaller company's sales and profits to its own. This helps the bigger company grow its total profits. Seventh, companies sometimes buy back their own stock. A company might use some of its profits to buy its shares from investors. When this happens, there are fewer shares left for other investors to own. Each remaining share then represents a slightly bigger piece of the company's future profits. This can help make each share more valuable. All these reasons work together. In most years, inflation, productivity, innovation, selling in new countries, more people, buying other companies, and stock buybacks help the total profits of companies go up. And because the stock market follows these total profits over the long term, this is why the whole market tends to go up over many years. 7. Market ups and downs. The stock market does not go up in a perfect straight line. We know that over many years the market usually grows, but sometimes stock prices go down. Sometimes they fall a lot very quickly. This is called a market crash. Market crashes can feel scary for investors because the value of their stocks goes down fast. Crashes often happen when people feel worried about the future. Maybe there is bad news about the economy, a big world event like a war, or problems with banks and money. This fear makes some investors want to sell their stocks quickly. When many people sell, prices fall. Seeing prices fall makes other people scared and they sell too. This can make prices drop even more. It is important to know that market crashes have happened before. They are a normal part of investing, even though they are difficult. But history shows something else important. The stock market has always recovered from crashes. After every big fall, prices have eventually come back up and reached new high points. Why does this happen? There are a few reasons. When times are hard, companies often have to change. They try new ideas to make money or save money. They might create new products, find better ways to work, or start selling online. These changes can make companies stronger for the future. Also, during bad times, some weaker companies might fail. The stronger companies that survive often get the customers from the failed businesses. This helps the strong companies grow bigger. Another reason is that governments often take action to help the economy during a crash. They might help businesses or give money to people to help them spend. Looking at the past, the market goes up much more often than it goes down if you wait long enough. For example, if you look at periods of 10 or 20 years, the market has usually given investors positive results. Some people try to guess when the market will crash so they can sell before prices fall. Then they try to guess when the market will start going up again so they can buy at the lowest price. This is called timing the market. But timing the market is very, very difficult. It is almost impossible to know exactly when the highest or lowest point will be. You have to guess right 2 times, when to sell and when to buy back. Most people who try this do not succeed. Often a better plan is to stay invested, even during the hard times. If you invest regularly and wait for many years, the ups and downs usually average out, leading to growth over the long term. 8. Smart investing ideas. Investing helps your money grow over time. One important idea is called compounding. Think about a small snowball rolling down a big hill. As it rolls, it picks up more snow and gets bigger and bigger, faster and faster. Compounding works like that with money. Your money earns more money, and then that new money also starts to earn money. It helps your savings grow much larger over many years. If your investments pay dividends, putting that money back into your investments makes compounding work even better. This is called reinvesting dividends. You might think you need a lot of money to start investing, but that is not true. Today, you can start with only a small amount. You do not need thousands of dollars. There are simple ways to invest. One easy way is using index funds. An index fund lets you own tiny pieces of many different companies all at once. It helps spread your risk. You do not have to pick individual stocks yourself. Another simple idea is called dollar-cost averaging. This means you invest the same small amount of money regularly, maybe every month. You buy whether the price is high or low. This is easy because you do not need to guess the best time to buy. It helps make investing a regular habit. It is also important to avoid common mistakes. Some people buy very cheap stocks, sometimes called penny stocks. These stocks often seem like a good deal, but they can be very risky and you might lose your money. Another mistake is selling a good investment too soon just because the price went up. Good companies can keep growing for a long time. Smart investing is usually about the long term. It is not about trying to get rich quickly by buying and selling all the time. Focus on owning good investments for many years. Understanding how investing works helps you be patient. Being patient is very important for success in the stock market over time. What's the most surprising thing you learned about how the stock market works?
Hey there! Just a second before you go. If you learned something new today, please give this video a like, write your thoughts in the comments, and subscribe to the channel. It only takes a second, and it really, really helps to create even better English videos for you. Your support means the world. Thank you.